Futures attempting to hold on to their rebound after yesterday's post-Fed wipeout. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, stocks staging a comeback after that hawkish Fed cut jolted global markets. Wall Street's biggest bull, John Stoltzfus, will weigh in. Also, on the earnings front, Micron plunging this morning with weak demand for smartphones and PCs hurting the largest U.S. maker of computer memory chips. And D.C. drama. President-elect Donald Trump opposes a proposed funding bill, increasing the likelihood of a government shutdown. All of that and more coming up. But let's take stock of these markets right now, because you can see the S&P 500 currently up about 0.7%. We had an absolute wipeout yesterday, down 3% after that hawkish cut from Jerome Powell and company. And you can really see that we're trying to dig out of the hole, but certainly taking a bite out of year-to-date gains. You take a look at the bond market, we are back above 4.5% on that 10-year Treasury yield, up 11 basis points yesterday, up another 4 basis points today, helped in part, of course, by that stronger than expected GDP reading that we got at 8:30. And I wanted to throw up the VIX as well. We got as high as 28 yesterday. Of course, that's still below the heights of the summer, but we're holding on to that right now, even though you do have some volatility draining from this market. That VIX still trading with a 21 handle. Shannon.
Yeah, just incredible. Higher volatility, danger zone on that 10-year. We're going to talk all about it. But first, we're going to look at some single stocks. Micron is suffering its worst drop since the pandemic. That's due to sluggish demand for its memory chips. But the company's CEO is optimistic about the second half of 2025. More on that in a moment. Micron, though, down more than 11% pre-market. Also watching Darden Restaurants, saw some same-store sales pick up for its biggest brands, Olive Garden, Longhorn Steakhouse. You have Darden up more than 9% pre-market. It is helping this firm's top Wall Street expectations for the year. Also looking at CarMax beat up more than 7% pre-market, thanks to a more stable environment for car valuations. Let's see if that sticks, Katie, with that higher for longer environment.
Absolutely, and that is what's in focus for markets today, that potential higher for longer environment. I was a bit surprised by how surprised the market was, given that, we've been talking and socializing the idea that the Fed is going to pause in 2025. But then you consider that Powell did say that the rate cut yesterday was a closer call than previous decisions. We were like 95% priced for a cut. So explains some of the shock and all, but even still.
Yeah, I am also surprised with that violent reaction, if you will, because you did, to your point, see the VIX ride higher. I'm impressed by just how violent the moves in the 10-year have been, not just over the past week. Since the beginning of last week, it's more than 15 basis points higher. But since those September lows, Katie, you're looking at a more than 95 basis point or 93 basis point rise higher in that 10-year since those September lows. So that's just how wrong the market has been. That is real money on the line lost.
Absolutely. A lot of people nursing that hurt today. And you have to ask, where's Santa Claus? I thought December was supposed to be a pretty good month. Let's ask some of these questions to Envestnet Co-CIO Dana Dioria. She joins us now. And Dana, we've been calling this a hawkish cut. I like how you phrased it in your notes, that this is a cut with a but. Of course, Jerome Powell having to add some asterisks to exactly what he delivered yesterday. Did this change your base case when you take a look into 2025?
No, I wouldn't say it did. And in fact, I agree with the comments that you just made. It's actually kind of perplexing that the market is still overshooting on its expectations for rate cuts, so much. And we've been doing it all year, right? I mean, we started the year with a massive rate cut expectation in the face of also an expectation that markets were going to do well. Employment is not suffering. And, inflation, while certainly coming down abruptly, the Fed's biggest mistake right now would be to let inflation take hold again, right? I mean, that would be a fail for this Fed of all the things that they could do. And so, it does surprise a little to see that the market still continues to overshoot on these expectations of rate cuts. I think now remember, right? Trying to predict what the rate cuts are going to be next year. All you've got right now is the information of knowing what we know today. The Fed chair and governors are saying, hey, look, it's probably closer to 2. That's a base case going into 2025. It's really kind of meaningless, right? The only thing we could say for sure is it's probably not exactly that. They're going to be data driven all next year the way they have been this year. but it's more an understanding of the information that we have today doesn't support this expectation of a lot of rate cuts next year.
Well, to the point on the uncertainty about next year, I thought it was also telling that he was asked if he could rule out a 2025 hike, and the answer was no. Of course, there's so many cross currents, so many unknowns, especially when it comes to the fiscal side of the equation. Economists have a lot on their hands, but how do you approach that from an investor standpoint? The possibility that we could have hikes enter back into the conversation.
Yeah, I think when you're thinking about advisory assets, which is what the Envestnet platform has, right? It's financial advisors and how are they allocating retail client assets, and for the most part, they're not going to make major changes in their portfolio allocations based on whether rates are going up or down. But what they might be thinking about is how close is my client to their existing risk tolerance? Is this something where I've been pushing on the equity side a little bit, or clients have been kind of pushing me into maybe or pushing for rather some higher allocations in a risk on sort of a framework, and should that be rethought? So it's going to be for many advisors, right? They're sitting in a portfolio that's based on long run expectations for that client, long run goal setting, et cetera. So incremental changes, I wouldn't expect much. Another place I do think, though, is going to be relevant is how much money people have sitting on the sidelines in cash. We've had a year of just, because rates are higher and you can earn more in these cash vehicles, you have a lot of money sitting on the sidelines that probably did belong in the market. And if you look at it, yes, you've earned a lot more in cash than you were in the last several years, but you missed out. If that's long-term money, you've missed out on really big returns in the market. And so I think the expectation that we have higher for longer could leave more money in cash, and that hasn't really panned out well for people.
But if you think about what's ahead, you're still looking at sky-high valuations, at least relative to what we've seen. We're still near record highs. And what is the case then for taking that cash out now? Why wouldn't you wait for a greater pullback, especially if you believe that we're going to still be in that higher for longer environment?
So that, you can go at it that way, right? I mean, we recommend that you not try to time the markets. It's notoriously difficult to time the markets. And so if you're sitting in cash and you're saying, look, at some point, I expect some sort of correction here or some of this exuberance to kind of come off, you risk that you miss rapid returns in the market. You don't know when those are going to happen. And as we know, when you look across, if it's 10% return and a market cap weight over time, it doesn't come, unfortunately, as 10%. It comes as negative, 10 and then 30% at another time. And so, our baseline recommendation is always, if this is long-term money, you're not trying to move in and out and figure out exactly when the market is going to do well. That, just having it sit in cash when it's something that you're not going to be tapping for 5, 10, 15 years, you probably are missing out on an opportunity. And again, we saw that happen this year. So we would say, that balance 60-40 is still a great place to put money. And yes, you do risk, of course, the chance that there is a pullback. I don't think that's certainly out of the realm of possibility at all. And there's a lot coming in the coming year, right? In terms of uncertainty around, you mentioned fiscal policy, what's going to happen with tariffs, what will happen with immigration? Is the rhetoric a lot stronger than what will take place? Perhaps.
It's interesting because I want to acknowledge some more of the economic data. Even after that shocker of that Fed report, you have a U.S. growth that was revised to 3.1%. Strong consumer spending was a real component of that. And you did see this year investors really wanting to bet on the consumer. You saw this consumer discretionary trade come back in fits and starts. But if you are concerned still about persistent inflation that could be under the hood here, how quickly could that tide turn? Is it still a bit of a dangerous trade given where we are right now?
So I think the consumer has certainly propped up, and I think what's propping that up, of course, is employment, right? We really haven't had, we've had some recognition, I think, and come across in numbers around a little bit of a cooling in the job market, but not any great degree. And that's, of course, what empowers the Fed to say, hey, we're really going to take it slow on rate cuts here. Of course, the Fed has a dual mandate, right? I mean, the stock market, notwithstanding what they seem to react to, perhaps, the stock market really isn't part of their mandate, right? Their mandate is employment and inflation. And so if you have a steady employer picture driving consumer spending, it really does empower them to say, look, we're going to be more concerned about inflation here. We know that inflation tends to come in waves. We don't want to take any chance that the inflation that we experienced, rears again. And so the bet on the consumer is really a bet on employment. I think when we're looking at data that's coming next year, and everybody will focus here, right, is what happens with that job picture, what happens with payrolls, what happens with the unemployment rate. We obviously have several different types of data points that come to us on employment. That's what's going to drive consumer spending, and that's what's going to drive whether that trade's going to work out.
And Dana, before we let you go, I do want to talk a little bit about crypto, which I wasn't expecting to do at 9 a.m. Post-Fed. But I'm taking a look at some of your notes. You note that on the Envestnet platform, you have about $6 trillion in assets, and at least $1.6 billion of that is in crypto. And I think that's really interesting. Of course, Bitcoin holding above $100,000. How are people actually incorporating it into their portfolios? Real investors, not necessarily just Bitcoin maxis.
Yeah, and those are, the ETF numbers, right? And so I think the big thing that happened in terms of the advisory world for crypto was the SEC decision that you can now have ETFs that follow cryptocurrency. And, that opened up a whole set of investors that wouldn't otherwise have been there, who don't want to worry about cold storage and, did I pick the right crypto vendor, et cetera. But now they have big asset manager names like BlackRock, like Fidelity, who are backing these ETFs. And so they don't have to worry about any of the operational considerations. It's just a question of, do I want a slug of this in my overall asset allocation? And when you look at the size of where crypto is, and there's indicators in markets that this is not, sort of just a retail phenomenon outside of the advisory world, you're seeing more now where not only advisory, but even institutional is bringing crypto into the play. You're seeing research out there that suggests that because crypto has such an opportunity to outperform, it's volatile, right? It's an incredibly volatile asset. So even a tiny slug in a portfolio actually raises the overall standard deviation of that portfolio in spite of, covariance potentially being low, right? And so you look at that, but at the same time, people even with a normal utility function might appreciate a little bit of crypto just because of the chance for it to have that lotto effect. And I think that's what advisors are looking at, in terms of those allocations. But, it is a volatile asset, and you're really sort of looking at it from a lotto payoff, I think, to put it in.
And at least for now, holding steady this week, above 100,000, despite all that volatility in markets. Envestnet Co-CIO Dana Daria, we thank you so very much for your time. We're going to also bring you some breaking news in the markets here because the Brazilian real hits record weakness. You are seeing that after central bank interventions. You're also seeing surging credit default swaps as well, which of course you would see in this kind of environment where you're seeing just that kind of weakness in the real. Stronger dollar, borrowing in dollars would make it really tough for those companies, of course, and therefore you see that real-time movement. We will keep an eye on that as we go along. Shocking also, Katie, that you're seeing central banks elsewhere in the world really making a mark on their own markets over the course of the week. Now, we mentioned Micron earlier. Shares seeing their biggest drop since the onset of the pandemic after providing a weak forecast. The company is now struggling with low demand for phones and computers. Bloomberg Technology's Caroline Hyde is at the table to discuss Micron and the tech trade. There were such high hopes. And you saw what happened with Broadcom just in recent days. There was excitement around the broadening trade outside of NVIDIA. Micron disappointed.
High bandwidth memory isn't disappointing, though. And that's the AI trade. That's the sexy part, which still goes great guns. And actually, give credit where credit's due to Sanjay Mehrotra, the CEO. He saw 84% increase in revenue in his fiscal quarter just reported. And he's seeing earnings up 300%. But we don't care, because it's about the forecast. And it's the forecast that significantly underwhelms, coming in more than $1 billion shy of the market consensus when it comes to revenue. This is all on the back of PCs and smartphones. Good old back to boom bust when it comes to the inventory of NAND in particular. This is a type of flash memory that is used across PCs, across smartphones in particular. And we're not upgrading as much as we used to. So that weakness is still feeding in, and it's not going to get better until the second half of the year, he says.
And it's interesting. We know that Micron, of course, really in the hurt locker today. It's been lagging the overall market, only up about 21%. But tell us about the competitive landscape when it comes to memory chips. Is this a Micron problem, or is this really an industry-wide sort of slump?
I think we're back to weakness across the board when you're looking at PCs and smartphones. We've heard this time and time again come from the other players. And that's why everyone's been putting all of their focus on this high bandwidth memory that goes in to adjacently work alongside the GPUs at NVIDIA and help the AI accelerators all get powered up and move forward. That is why SK Hynix has been all in on that trade. Samsung been desperately trying to. And overall, Micron, the biggest maker of memory chips here in the United States, has wanted its innings too. This is a company that is having to navigate so many headwinds. You and me, as the consumer, not upgrading our phones, but also it's got exposure to China. About $3 billion of its $25 billion for the full year of 2024 comes from China. What is the issue when it's in the push and the pull of the politics that is the trade war that we're currently experiencing?
That's true. It's industry dynamics, but it's also geopolitics. Really looking forward to the coverage on Bloomberg Technology, of course. That is Bloomberg's Caroline Hyde. Catch her on BTech at 11 a.m. But don't go anywhere, because coming up, President-elect Donald Trump shaking up Washington again as he trashes the House Speaker's plan to avoid a government shutdown, and actually just telling NBC that he would support abolishing the debt ceiling. We'll get into all of it next. This is Bloomberg.
There are a few things going on. First, as I said, we've been in very close contact with the incoming administration. I've spent a lot of time with Senator Rubio and Jake Sullivan, the National Security Advisor, with Mike Waltz, his successor. We've had very good, not only conversations, but we're trying to make sure that we're as coordinated as possible so that they know what we're looking at doing in the remaining time that we have. I want to be able to hand off to the incoming administration the best possible hand to play in all of these areas, in all of these challenges.
That was outgoing Secretary of State Antony Blinken speaking to Bloomberg's David Gura about the Trump transition. And speaking of the Trump transition, let's talk about the federal funding battle reaching a tipping point. President-elect Donald Trump opposing a proposed stopgap funding bill that would keep the government running. He just told NBC that he would support abolishing the debt ceiling. So let's talk to David Gura. He is the host of the Bloomberg Big Take podcast. He's sitting to my left. Of course, this was a bipartisan agreement. Now it's in jeopardy. Talk to me about the Elon Musk of it all.
Well, here we go. I mean, I think we kind of expected that there would be events like this during the course of the Trump presidency, the second Trump presidency. But the Elon Musk of it all is that he, in this kind of unelected but powerful person within the Trump orbit, has been swaying things in different directions. So he's tweeted, I think, more than 100 times about what was in this bill, which was a substantive 1,500-page
I did actually
resolution.
try to scroll back, and it was impossible.
Too many of them.
Yes.
Too many posts on X. So what we have now is all told, Musk, J.D. Vance, and Donald Trump coming out against this. And this is a bill that we had Mike Johnson put together over the course of many months, and there was just a lot of blind hope and optimism that it was going to get through before this shutdown deadline this weekend.
Speaking of Mike Johnson, I'm glad you brought him up. You have the president-elect really commenting on his role here. What does this mean for their relationship heading into next year?
You know, he has very assiduously tried to create and cultivate a good relationship with the president-elect, and this now throws all of that into whack. So now pivotal moment, aside from the shutdown deadline, is January 3rd, when there's going to be a speaker election. And remember just how he got the job in the first place. It was this long string of votes to find a House Speaker. He was by no means at the top of that list to begin with. So one wonders about how he is in Trump's estimation. It's kind of a fool's errand to try to figure that out. But certainly he's in a very precarious professional position at this point.
Does Joe Biden factor into this at all? Is the current administration a factor in this in any way? Or is this really just, President-elect Donald Trump hitting the ground before Inauguration Day?
I used to live in Washington and cover Washington, and no administration likes to see a government shutdown. It has huge negative effects on people and their lives. And so we've seen that kind of messaging from the White House, again, as we have in kind of run-ups to shutdowns past. They're doing the same thing now. I think they're worried, but squarely now the ball is in Congress's court in a way that it has been all along. So I expect we'll hear them weigh in on this, but it really is up to Congress to figure out.
I want to also go back to that conversation. We came in with it, that conversation with Secretary of State Antony Blinken about what's happening in Syria, about what's happening really across the world at this point. But when it comes to Syria in particular, I thought your conversation was very interesting on how he sees the path forward evolving and how they might start to approach sanctions policy.
They're in a really tricky position right now because the kind of de facto leadership of that country is a group that the U.S. designates as a terrorist group. And he has acknowledged the fact that the U.S. has reached out to that group. There have been conversations. But I said to him, look, this is a country that's sort of heavily sanctioned. You have this terrorist designation, but you have these sanctions in place. We've had a Democratic senator, suggest that those should be suspended temporarily. I asked if that was something that he would consider, so how he's looking at sort of the sanctions picture and his ability to sort of engage with what may be the new government in Syria.
We're looking at all the authorities we have. We're looking at all of the sanctions, not only our own. The United Nations has sanctions on HTS, its leader. And I think what we need to see is actual concrete steps building an inclusive, non-sectarian government, a transition, eventually getting to an election. As we see these steps taken, then I think we'll be able to respond. Others will be able to respond.
He stressed to me that this is kind of a moment when the U.S. is watching hour by hour to see what's happening here. There are a lot of groups kind of vying for power in the country. There is this one group that's backed by Turkey and was affiliated with al-Qaeda before, now seems to be coming into power, having shed a lot of that history. They're waiting to see sort of what happens here. And I just brought up with him in that conversation as well. Sort of, we've been here before. We've seen these power vacuums emerge. This is a particularly precarious time for a country like Syria, when there is kind of wait and see what's going to happen, who's going to be in charge.
David, really great interview. Thank you so very much for bringing it to us. That is David Gura of The Big Take. You can listen to more of the Blinken interview and more on The Big Take podcast anywhere you get your podcasts. Stick with us. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a look at futures right now. Seconds, minutes away from the opening bell. You can see trying to rebound on the S&P 500, which of course fell by nearly 3% yesterday. That was its worst daily drop since August. Its worst performance on a scheduled Fed day since 2001. So quite a hole to climb out of. You take a look at big tech. You take a look at the small caps as well. Really feeling the pain yesterday, trying to stage a rally today. We'll see if that holds. And we'll discuss the base case next with John Stoltzfus. He is currently Wall Street's biggest bull, a 2025 price target of 7,100. We'll ask him whether that's changed. This is Bloomberg. All right, we are moments away from the start of trading on this post-Fed day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. Of course, the reaction was swift and brutal yesterday to Jerome Powell's comments and that dot plot, penciling just 2 rate cuts next year. Also, Jerome Powell not ruling out a rate hike in 2025. That really spooked the bond market and that spooked the stock market. But you can see, at least in futures, trying to regain some of that momentum that we've been enjoying in 2024. And nevertheless, the bells ring. You can see down at the New York Stock Exchange core bridge. You take a look over to the NASDAQ right now, and someone else is ringing the bell there. In any case, let's get to the market action because that's what we're really excited about. The S&P 500 currently higher by about 0.7% in the first few seconds of trading. Big tech too, also managing to build a rally here. Small caps are interesting, of course. Really, this index taking a beating yesterday. Those small companies really banking on lower rates in 2025. That was worth a 4 to 5% decline yesterday, but of course, the Russell 2000 up about 1% at this moment. We'll see if that holds. But let's get under the surface right now because it's still earnings season. And we did get Darden Restaurants, of course, which provided a forecast that topped Wall Street's estimates as its largest brands generated positive same restaurant sales. That is worth an 11 to 12% gain. We also have to highlight CarMax. These are both happy stories. CarMax jumping after quarterly sales and revenue beat expectations. The CEO said that stable car valuations helped the company outperform. Sonali, that's good for a 10.7% increase.
Pretty impressive. I'm also keeping an eye on some stocks reporting after the bell. Earnings season still not over. Heading into the end of the year, Nike up about 0.6% as the market opens. The new CEO takes his first earnings call with the street, looking for information that could revive the brand, making Nike cool again. Listen, Nike has been down almost 30% this year alone. FedEx is also expected to report a profit boost for the most recent quarter, and we're going to listen to details about holiday activity. We're also taking a look, of course, at Micron, down bigly, more than 14%, almost 15% as the market opens. Its 2025 forecast disappointed. Micron is the largest U.S. maker of computer memory chips, and its CEO expects a return to growth in the second half of the fiscal year. We're going to take a closer look at Micron with Bloomberg's Abigail Doolittle.
It really is pretty incredible, Sonali. This drop that we're seeing for Micron, the worst day since 2020, and this guide down is is incredible as well. The worst or biggest, to my memory, for a major company. They are talking about $1.1 billion basically just disappearing. The EPS, not as much, but from the sales perspective, weakness for smartphones, weakness for PCs. Interestingly, the offsetting factor is AI demand for a particular type of component. But again, that weakness for smartphones and iPhones creating a big problem. In fact, on the shares, let's put it into the perspective of that worst day since 2020. Here you can see this massive drop lower, and this is a year-to-date chart, so we can't even see, but it's very clear that this is the worst day over the last year, the worst day since that massive selling pressure driven by the pandemic back in 2020. And then finally, well, how's Micron doing when we compare? Well, going into today, today's drop is certainly huge, but investors aren't entirely shocked because going into today, Micron was up just about 20% on the year. You compare that to NVIDIA up about 160% on the year, and then Broadcom up 100%, along with Marvell Technology up, let's call it 75%. Well, Micron was already suffering. Now, just up single digits on the year. This is a chip maker that is certainly underperforming relative to the peers, Katie.
Absolutely. I mean, it's operating in a pretty tough market right now. Memory chips for smartphones and PCs, definitely not enjoying what some of those chip designers are. But let's broaden out this conversation right now, because I'm pleased to say that we're joined now by Oppenheimer Chief Investment Strategist John Stoltzfus. He is the most bullish strategist for the S&P 500 on Bloomberg as of right now, predicting that the index will hit 7,100 by the end of 2025. John, it's great to see you in person.
Well, great to be here. Thanks, Katie.
So we do want to get to that price target, but let's look back first, actually. Let's talk about what happened yesterday. We were having this conversation right before the segment started that actually the seeds of what we saw in the stock market yesterday, it was the bond market tantrum that really set things off.
Yeah, I really think it was the bond market threw a real hissy fit. And on top of it, then it caught the equity market moved lower as well. And a lot of this has to do when you get change of policy occurring at the Federal Reserve, especially when you've had high levels of inflation and they've succeeded in bringing it down significantly. The process is never smooth. It takes time to realize the effects of a tightening cycle and then the beginning of a loosening cycle. And the Fed can't move too fast in either direction, really. It has to be careful. It's got a dual mandate to maintain an economy that can grow at a sustainable pace without a lot of inflation, at the same time not causing unemployment that would rise above 3 or 4%, which is considered full employment. We continue to feel that the Fed's doing the right job here. The consumer's in good shape. Businesses are in good shape. We just saw the third quarter earnings were very strong. We expect fourth quarter earnings will be pretty good coming in when we get after the new year, when we see how those work. So all in all, we remain positive at this time.
And I mean, you can see if the bounce back today, the S&P 500 up about 1% after that 3% decline yesterday. And square the circle of how surprising yesterday actually truly was. We were talking about this at the top of the show, that we've been talking about the idea that the Fed will pause in 2025. Of course, to see that actually reflected in the dot plot seems like that shocked some people.
Yeah, you know, and some of it is just a desire to be shocked, we'd have to think. We're always reminded that there are many communities within the market at any given time, whether it's the stock market or the bond market, but it really is split between traders and intermediate to longer term investors. And the traders are looking for action. They are looking for opportunity, any catalyst that they can find within a bull market to take profits without FOMO. And they sure found it yesterday. And a lot of what happened was an unwinding of trades that are very complex. If you consider that this year looks a lot in parallel to last year. If you remember last year about this time, Powell intimated that the Fed would be cutting rates. He gave an idea, I think it was like about perhaps twice they were going to cut or so. Immediately, the bond market thought it would be many more cuts. They thought a recession was likely. And the reality is, this time around, you know, it's still a Ben Bernanke legacy Fed. It's highly communicative, but yet the market doesn't trust it. It just, you might as well have Greenspan in there for all the way that the market is acting. But the reality is the fundamentals remain remarkably good. And on a global basis, too, we stand out.
Speaking of fundamentals, it's interesting to see that jump back in the S&P 500 as we've been talking about this, more than 1% gain. Yes, it doesn't correct us for all that we've lost yesterday, but it is the biggest gain you're seeing in the S&P 500 since the election.
Right.
And so if that's the case, you're led higher today by financials, by consumer discretionary, you have strong earnings out there. How much do you believe in the broadening trade still, even with this recalibrated picture of what the interest rate story could look like and potentially some persistent inflation risks?
Well, very much do we believe in this broadening of the rally that we've seen. Well, it really has been. Yesterday was a setback significantly, we think, for the progress that both mid caps and small caps had within the large cap space. 3% decline based on what the S&P 500 has done on a year-to-date basis, what the NASDAQ composite has done on a year-to-date basis. And the 11 sectors, at least 5 or 6 of those doing remarkably well this year in double-digit gains. We'd have to say it's a haircut. It's more than a trim. Last week's volatility was a trim, and this week is a haircut. But it's not, does not look like a correction about to happen. And a lot of it has to do with that uncertainty and the catalyst that it creates for bears to take advantage, to take some profits, myths a bull market that is undeniable in many ways, without FOMO. And it's the way the markets go. It's too many sides to trades, but primarily 2 sides of the trades.
So if you are worried at all about what next year looks like, I know that you're not one of those bears, but what is the risk to your price target? What would cause you to rethink it, especially as we stand here today? We are below, even just with a haircut, we are below that emotional 6,000 level on the S&P 500.
Yeah, I think the 6,000 might well be achieved between now and the end of the year fairly easily. I don't know if my adjusted 6,200 target, that we went from 5,900 to 6,200, I don't know if we'll get to 6,200, but I'll take 6,000. But we might even do better than that. You never know. There's enough days left for Santa Claus to arrive and get a Santa Claus rally here. But in terms of what could be problematic, it's that argument between the markets related to is inflation still too sticky? Is the Fed overreacting to the stickiness of inflation? The desire for many cuts in interest rates by highly leveraged players in the market, who very much have the ear and the eye, both of the press and the audience, really, because that's where the drama happens. It's the action. You know, if you're an intermediate to longer term investor and you look back to the 2 dates that were prominent in the reports today, that what it was in March of 2020 and going back all the way to 2001, and then you look where the S&P 500 is from there. Oh my gosh, it's like, you know, it says it's a mistake to leave time in the market rather than trying to time the market. And the other thing is, we really do believe that the market is now comprised significantly of private investors who are investing like longer-term institutional investors for needs in a retirement, putting kids through college, leaving a legacy, a family legacy, or a legacy to a medical institution or a university. And that requires a lot of patience and the ability to get over quarterly disappointments and FOMC meetings that occur and take a look at the longer-term picture, which really does appear quite good at this point.
More people looking for that opportunity to set it and forget it, Katie. Oppenheimer Chief Investment Strategist John Stoltzfus, of course, the biggest bull on Wall Street. Thank you so very much for joining us, and happy holidays to you. Now, coming up, the head of Nike will face his first earnings call since filling the CEO's shoes. And Wall Street has a lot of questions for him. We're going to give you an earnings preview next. This is Bloomberg.
It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Mizuho is upgrading Stanley Black & Decker to a buy. The firm also naming it a top sector pick, with the analyst saying that tools are bottoming and the tariff picture is now priced into the shares, currently up about 1%. Next up, we have Oppenheimer raising its rating on Block to a buy. The firm says that the digital payments company should see volume growth in 2025, and also that the company's Bitcoin mining strategy should fuel profit. And finally, we have Telsey Advisory Group downgrading European wax center, saying it's no longer a buy and cutting its price target. The firm cites concerns over the company's growth prospects, and the hair waxing salon recently hired the former CEO of Dave & Buster's to lead its operations. That is quite an interesting career switch. But in any case, let's talk about Nike CEO Elliott Hill, because he's going to face his first earnings call today since taking the top job in September. Wall Street, of course, seeking many answers when it comes to repairing retail partnerships, unifying staff, and making Nike's brands cool again. Here's what Dana Telsey of the Telsey Advisory Group told us on Monday.
He needs that core Nike brand to be new and different. Look what we heard, for example, on Foot Locker's call, where non-Nike branded product perform well. He needs to be at the center of the cultural conversation, and it's missing right now. How does he bring back that aura of a company who has such share and such resources available to them? I want to hear how he's going to instill that way to win and that swoosh that means something back in the conversation.
Joining us now is Poonam Goyal. She is a senior analyst for Bloomberg Intelligence. And Poonam, of course, it's a long to-do list for Elliott Hill over at Nike. What do you think should be first?
I think the first focus is to make himself and the brand more recognizable in the running and lifestyle categories. Those are two categories where Nike has literally let the share slip. And if they can win any of those categories back, even slowly, I think they'll make a difference.
How high are the stakes for him? Because even if the numbers are backward looking in this regard, are there serious expectations for him to lay out a really credible plan moving forward? How high is that bar?
So we know the quarter will not be great. That's expected. But we want to hear from him, what is he going to do to turn momentum around, to get sales to rise again? It won't happen in the next quarter either. It will take time. But as we move into calendar 2025 and the end of their fiscal year, we should start to see some improvement. So will he outline a plan tonight? Probably not. But should we expect one in the near future? Absolutely. They delayed their investor meeting because he was appointed just around the corner then. And we do need to hear more on how he will revive the Nike brand, largely in running and lifestyle.
They also, of course, withdrew their full year guidance, so they really wiped the slate clean for Elliott Hill. And I'm curious, I mean, we're waiting for a plan when it comes to their core business, but he has made some moves. They did sell off their virtual sneaker division. I'm not going to try to pronounce that, but they had bought that in 2021. How much more fat of that sort of vibe is there to trim when it comes to Nike?
There's not that much more fat. I mean, the biggest thing that he's done in my eyes is he's brought back leadership, right? He's brought back a team that was core to Nike to really bring Nike back to its roots. So I think that's one of the major things that he's done since he's been put at helm. And I think that will make a difference. As we move into calendar 2025 and the back half of their fiscal year, we should start to see changes in product. We should start to see them getting more involved in community. Both things that will make a difference if they're executed right.
And I just want to talk about the competitive landscape a little bit here, because you think about Nike's troubles, the issues they've been having over the past several years. In that time, Poonam, as you know very well, they have some real rivals take market share. You think about On, you think about Hoka's, for example. It's not as simple as just righting the ship. It feels like they have to take back market share as well.
They definitely have to take back market share. But what I will tell you is we ran a survey just recently last month, and Nike still remains the prominent brand when asked about what do you wear for running? What do you wear when you go out? So Nike has the mind share. They just need to win the share that they've lost recently. And when you look at the size of Nike and you look at the size of On and Hoka, yes, the growth rates have been exponential at the competition, but they still dwarf Nike. Nike is still 10 times bigger, at least, than either of those brands.
Poonam, we thank you so much for all of your analysis. That is Poonam Goyal of Bloomberg Intelligence, and looking forward to what happens today after the bell for the footwear giant, sorry. Coming up, companies that spent billions to buy other businesses during boom times are starting to regret those purchases only a few years later. Selling those assets now for a fraction of the original cost. We're going to talk about that next in our Wall Street Beat. This is Bloomberg.
Welcome back to Bloomberg Open Interest. A quick check on that post-Fed rebound coming in a little bit. You can see the S&P 500 up about 6 to 0.7%. Big tech still higher, 0.5%, but we were higher in the pre-market. The Russell 2000 up about 0.9%. Volume, I will note, Sonali, is much higher than you might expect for December 19th. Currently trading 19 to 20% higher than our 20-day average right now on the S&P 500.
It's the day after the last day that mattered, and it turns out more days are starting to matter. Anyways, it's time now for the Wall Street Beat. While overall M&A volumes have risen 16% this year, we are seeing still divestments of acquisitions that didn't work out in recent years. Take Alibaba for an example. It's selling the department store chain in time for $1 billion, and that's 30% of the company's valuation when Alibaba bought it. Bloomberg's Michelle Davis covers deals and joins us, and I remember the first assignment I had at Bloomberg, and it was to calculate the synergies across all of the deals that were done during the boom times, and many of them never came to the announced fruition of those synergies initially announced. So is that a cautionary tale going into next year when you're thinking about those 30, 40, $50 billion deals that are being discussed? Are some of these going to be just a bad idea?
You know, there's that famous line from Warren Buffett, when the tide goes out, you can see who's been swimming in their skivvies. And I feel like that really illustrates what's been happening here. A lot of these deals were struck during boom times, an era of euphoria. Interest rates were at rock bottom. And competition for deals was really fierce. So a lot of companies and potential buyers were really rushing through diligence. They were really rushing through deal processes because they wanted to be the one to buy these companies. But they weren't always taking the time to think about, are the synergies going to pan out? What are the assumptions that I'm basing all of this on? And I do think we're starting to see that happen now with some of these, companies having to really cut their losses. To come back to your question, I do see it as a cautionary tale, but I don't think we're quite in that environment now because obviously interest rates are higher and companies are having to be a lot more sober and reasonable about the types of deals that they're doing. That's why deal environments haven't fully recovered to what we were seeing, 2017, 18 through 21.
Well, we have just over a minute left, but we opened the segment talking about Alibaba. Give us some more examples, for example, because I remember Just Eat agreeing to sell Grubhub. That was a pretty quick turnaround, and seems like they might have taken a bath on that one.
There was another big one that happened during the pandemic time, Teladoc and Livongo. I think they paid around $18 billion for that. They've written off so much of that value. I think Teladoc is now trading around $1 or $2 billion. In the healthcare space, there are a lot of these examples. I mean, CVS is right now under pressure because of some of the mega mergers that it completed years and years ago. And
$70 billion for Aetna.
Yeah.
Wow. Incredible.
And investors right now, they want to see profit. They're not rewarding growth the way they were before. And so companies are just being a lot more thoughtful.
CVS's entire market cap is less than that now.
Yeah, CVS. We were talking about Micron in the Hurt Locker. CVS, truly another C-suite shakeup there, of course, which we'll be keeping an eye on. Michelle, great reporting as always. You're going to have a busy 2025, so enjoy the holidays. That is Bloomberg's Michelle Davis. And we take a look at markets right now. It'll be interesting to chat through the trade, of course. We're seeing this big bounce back, of course, but it's been an ugly week, and you have to wonder if we're going to see some year-end window dressing come in. Maybe we'll see Santa reappear, but certainly nursing a down week on the S&P 500. Coming up to talk through, of course, the Fed and everything else in the markets, we'll speak to Shannon Grein from Wells Fargo about that hawkish Fed cut, and then we'll talk with Tina Fordham on the looming government shutdown. We'll also speak with Dynex Capital's Co-CEO discussing those mortgage markets and commercial real estate. Don't go anywhere. This is Bloomberg. All All right, we are 30 minutes into the trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today.
And we take a look at these post-Fed markets. Still green, of course, but not quite the robust rally that we saw earlier. The S&P 500 up about 0.6%. We were looking at gains of 1% just about 30 minutes ago. So some of that enthusiasm coming out of the market. We do have economic data, of course, in the form of existing home sales for November, coming in at 4.15 million for November. That is slightly higher than expectations of about 4.09 million, and it's certainly higher than the prior reading of just below 4 million. So there you have it. Also on a month-over-month basis, existing home sales increasing by 4.8%. The expectation had been for 3.2%. So clearly a big rise there. Maybe some unfreezing, unlocking of that home market that we've been talking about when it comes to real estate over the past week, Sonali.
Yeah, we have some more breaking news as well, of course. A lot of people watching this very closely. Luigi Mangione, who has been the suspect in that Midtown shooting of the top United Health Group executive, Brian Thompson, has agreed to be sent to New York on murder charges. He is this morning in Pennsylvania court to face charges over carrying an illegal gun and showing a fake ID, and his extradition now to face those murder charges is going to be underway. We're going to switch back to the markets now. We're going to talk to Shannon, Seery, Grein. She's Wells Fargo's economist. And of course, Katie had just broken down that home sales data, and it's relevant for a lot of reasons. You had that GDP data this morning. We had that conversation about the consumer being strong, yet you also are sitting here in the aftermath of that Fed decision where that higher for longer reality is setting in. How do you think about the path forward into next year when you are grappling with those kinds of rates as well as those concerns around potentially persistent inflation?
Yeah, so I think that what we heard from the Fed yesterday is they're going to take a cautious approach to policy next year. I don't think that's too much of a surprise when you think about the data we've received since their last meeting, as well as the presidential election results, just with the new policy regime going forward. But inflation's been a bit sticky. Growth is holding up quite strong. So you mentioned the data we got this morning. GDP was revised higher on a stronger consumer profile. Recent retail sales data for November suggests that the consumer is tracking really well into Q4 as well. So the Fed's not really in a rush here to lower rates any further, particularly, again, when inflation's a bit sticky and the labor market's holding up decently well, right? Not nearly deteriorating as fastly as they previously expected. So I think the Fed's correct to be a bit cautious going into next year. And, the timing and degree of further easing remains uncertain, but we'll obviously see kind of how the data evolves into the new year.
Yeah, the Fed's certainly taking a wait-and-see approach here. A lot of cross-currents, if you want to call them that, next year. So it makes sense that they want to preserve their optionality. But can we talk about where in the economy where policy still is restrictive? Of course, a lot of people have been pointing to the housing market, existing home sales this morning, maybe going against that narrative. But are there any areas of the economy that really need lower rates right now?
Yeah, so the housing market, manufacturing, these more interest rate sensitive sectors of the economy are certainly feeling the weight of higher interest rates. When we think of the consumer, unless you're relying on revolving credit card balances or credit card debt each month, purchasing a new home, purchasing a new vehicle, you're not that interest rate sensitive. So other than those more interest rate sensitive areas, I think the economy is holding up reasonably well, right? That's the signal the Fed's receiving, and that's why they don't have to necessarily continue to lower rates as quickly as they have. When you layer on the uncertainty that's come with a policy change, right, from a fiscal perspective, with President Trump winning the White House and a Republican-controlled Congress, I think there's just this layer of uncertainty of kind of a wait-and-see approach as they head into next year. So I think these interest rate sectors of the economy are probably going to remain under pressure going forward, particularly around the uncertainty around yields. But we'll see kind of as the Fed delivers potentially more cuts next year and where we get the certainty from their comments in coming weeks.
Even if there are less cuts than expected, there are still cuts expected at this point in time. And investors have largely been enjoying not only a growth story at present, but this idea of a pro-growth story ahead. If you think of what can knock the economy off the wagon, what are the biggest risks here that you're keeping an eye on that would change the course of what we're seeing right now?
Yes, I think the biggest risks are the obvious one, which is potential further tariff policy, right? Just the uncertainty with that. Which tariffs do we actually see put in place? Is it just the hard stance on China, or do we see more of a universal tariff come into play? And then the other one that's flying in the background for the radar, on the Fed's radar, is the labor market. So obviously the labor market has shown some signs of moderation and deterioration, but I don't think it's a straight shot lower, right? It's not a linear progression in terms of further deterioration. And that's really from where we sit that I think is the biggest risk in terms of the consumer. So consumers are obviously a bit more price fatigued. They're price sensitive. We've seen that in the data despite overall consumer spending remaining robust. But if you start to see labor market weakness broaden out or become more serious, that's when I do get a little bit more worried that you'd see more of a pullback in consumer spending and therefore more of a growth slowdown. So I think those are two of the risks we're monitoring, and obviously the Fed is certainly paying attention to, given their mandate of price stability and maximum employment.
Well, let's talk about price stability a little bit more because, of course, the new projection is that inflation will decline to 2.5%, at least according to the SEP. Powell didn't exactly express confidence in that reading, though. He talked about the high uncertainty of inflation's future path. Also, he did note that progress has been frustrating, which was very candid coming from the Fed chair. How much confidence do you have when it comes to inflation's trajectory to the downside?
Yes, I think what we heard from Powell is kind of consistently what we hear about those projections, right? They're a good exercise for the Fed. They're a good exercise in terms of what markets can look at of how the Fed is thinking about inflation and growth variables in general, but we shouldn't take them at face value, particularly going into next year with just the tremendous uncertainty that comes with tariff policy and trade policy in general. So I agree there's a lot of uncertainty around those estimates. We do look for a further moderation in inflation, but we're also in line with the Fed in terms of we expect it to be a bit sticky because we do expect some sort of tariff policy to come into play next year. Now, it really, in our view, depends a lot on tariffs, right? You obviously have a little bit more sticky sources of inflation that have been at play in recent months, such as shelter, and even that services side, ex-shelter, that's been, I think, supported by a robust consumer spending profile. So I think we're fairly confident you're going to continue to see a moderation, but then you get that upside pressure from tariffs, particularly in the second half of next year. So all else equal, it's moderating, but remaining a bit sticky and remaining a bit above 2%, which all else equal means rates are going to be a bit higher in the next year.
Shannon, we thank you so much for your time. That is Shannon Seery Grein of Wells Fargo. We thank you so very much for joining us. Now, coming up, a government shutdown looms as Trump demands that Republicans sink the spending deal. We're going to discuss the latest with geopolitical strategist Tina Fordham. That conversation is up next. This is Bloomberg. The Biden administration is preparing for a transition of power. U.S. Secretary of State Antony Blinken sat down with Bloomberg Big Take anchor David Gura. They talked about the efforts to aid a transition in Syria and his conversations with the incoming Trump administration.
There's one president at a time, one administration at a time, but we're in very close contact with the incoming administration. I spent a couple of hours.
It does feel novel, though. I mean, we used to talk about the Logan Act. Yeah. It does feel like these are different circumstances.
Look, I think there are a few things. I think there are a few things going on. First, as I said, we've been in very close contact with the incoming administration. I've spent a lot of time with Senator Rubio and Jake Sullivan, the National Security Advisor, with Mike Waltz, his successor. We've had very good, not only conversations, but we're trying to make sure that we're as coordinated as possible so that they know what we're looking at doing in the remaining time that we have. I want to be able to hand off to the incoming administration the best possible hand to play in all of these areas, in all of these challenges, because the world doesn't stop just because we're in a political transition. It's also normal that countries around the world want to hear from the incoming administration. They want to know what they can expect, and so they can get ready for that. As long as we're communicating closely, which we are, and as long as we're working to, again, try to make this handoff as effective as possible so that they can get moving on the run, because there's really no time to wait, then I think that's a good thing.
And that was Antony Blinken there telling Bloomberg's David Gura about the transition to the Trump administration, which got a little bit more dramatic, of course, in the last 24 hours with the federal funding battle reaching a tipping point. President-elect Donald Trump opposing a proposed stopgap funding bill that would keep the government running, telling NBC this morning that he would support abolishing the debt ceiling altogether. David Gura, I'm thrilled to say, is sitting to my left. And talk me through the timeline here, because Congress has, less than 2 days to sort this all out?
Yeah, the deadline is 12:01 a.m. on Saturday, so we're dealing with a very compressed timeline. And so President-elect Trump has just thrown another wrench into all of this. He called up Garrett Haake from NBC News on the phone and said that he would be in favor of doing away with the debt limit. All well and good, I suppose, but nothing that's going to get handled here over the next 24 hours. So interesting to have that insight. I think it just kind of complicates further the conversations that are taking place around this. And House Speaker Mike Johnson had spent many weeks hammering out this wide agreement that he thought was going to sail through, 1,500 pages. Yes, there were externalities in there, money for North Carolina, for instance, which had been hit by hurricanes. Now all of that is kind of being hotly debated once again, and here we are being forced to have these debates.
We saw the photo of it on Twitter as well. It did look big.
Yeah.
Notwithstanding the political ramifications of all of this, I'm going to cite Terry Haynes here that all of this is over a 3-month temporary spending bill whose excesses could be corrected and improved in March when Trump and Republicans are fully in charge. Isn't there something about this that's a little inefficient and there could be some real damage done if they keep on playing with the government's finances?
Yes, and here we are again. I mean, this has happened over and over again. We used to have something called regular order and kind of a standard budgeting process. We don't have that. So you're absolutely right that we keep finding ourselves in this position where we're getting these stopgap spending bills that last for just a number of months. It's no way to run a railroad or a company, and the U.S. is kind of unique in having this kind of debt limit apparatus as well. I think that that's where President-elect Trump's, if I may guess, where his frustration is born. It's just this is an inefficient way to run things. Just to underscore something about that debt limit, which was so important, it is authorizing the Treasury to pay existing bills. So we are having these conversations about cutting government spending. It has nothing to do with prospective spending. It has to do with what the government's committed to paying already.
And we have plenty of people from Congress weighing in. This coming from Senator Elizabeth Warren just this hour saying, I agree with President-elect Trump that Congress should terminate the debt limit and never govern by hostage taking. Joining us now, let's bring in Tina Fordham into this conversation. She, of course, is Fordham Global Foresight Founder and Geopolitical Strategist. And Tina, I want to talk about the role that Elon Musk has been playing because it seems pretty sizable. And I will point out that Elon Musk has not been elected to anything.
The irony is not lost on many of us that Elon Musk rails against unelected civil servants and how they should lose their jobs, and he himself is not elected. But there's no getting away from the fact that the Trump administration and his little tech buddy, Elon Musk, feel they have a mandate to do this. And, you know, we are back to looking at government by tweet. And Elon Musk said, about an hour ago, stop the steal of your tax dollars. You know, we're about to find out. I think what might take some of the enthusiasm away is if you start to see a reaction in the market to this these shenanigans.
What does this all mean, Tina, in terms of the uncertainty that could be created next year? If you have elected officials looking to move forward with policy, negotiating with each other to get the job done, and then a third party swooping in, multiple third parties swooping in to stop those negotiations in its tracks, then what does it mean for policy making down in D.C. for what could be much bigger issues down the road?
Indeed, what does it mean for policy making in D.C. and how do companies and other countries position themselves to respond to this degree of uncertainty? And I do think the other side of the equation is lost. I mean, listen, I spend a lot of time talking to investors, and they are still focused on the most positive aspects of the Trump policy agenda. And indeed, there are many reasons for optimism there whenever we have deregulation and other changes. But the kind of virtue that Trump and Musk and Vance make of being keeping everybody on the back foot and shaking things up means it's very hard to plan as well. So we're about to see what those trade-offs really look like. Are they effective? Is it worth a government shutdown? I mean, I remember 2008. That was fairly traumatic.
Just jumping in here, and maybe Tina can chime in here as well. I'm struck kind of situating this in the conversation that I had with Secretary Blinken this morning just about the potential for confusion when it comes to waging foreign policy while you have an incoming president kind of doing that in parallel. So we've seen him go to France, and he's met with the president of France. The Prime Minister of Canada flew down to Florida to meet with him. We have his kind of designate to be the Middle East envoy meeting with Qatar and other countries in the Middle East. I think we're kind of seeing that play out both domestically and internationally. And Tina, I wonder just if you could speak to the amount of confusion that's likely to call. We heard from the Secretary of State, his emphasis that just continuity is what's most important here, but it has to be something that's at least causing some headaches within the State Department and other diplomatic circles.
Headaches in the State Department, but headaches in every government affairs department in every company, American or otherwise. Business as usual, it has become a dirty expression, shaking things up, the tech mantra, moving fast and breaking things. When you apply those principles to government for the biggest economy in the world, yes, some things might be broken, and nobody knows where the collateral damage will fall. Now, I think for Musk and Ramaswamy and the others, this is an exciting prospect for them. And market participants chose not to take seriously the kind of fire-starting element of their agenda. It reminds me a little bit of people who said that they canceled their Obamacare and instead signed up for the ACA. I mean, how much are people paying attention to this? Not very much. So we have 2 very fraught days ahead.
Well, give us a global perspective here about how world leaders and, of course, maybe people in other countries are perceiving this. You bring up Musk, you bring up Ramaswamy, you think about this spending deal drama that we're having right now. What's the global perspective?
That this is going to be an unpredictable administration, that it will be impossible to so-called Trump-proof. This is an expression that was used in Brussels in the previous few months. And I mean, it's certainly not a bad time to be in the business of geopolitical advisory. But the most important takeaway is, it sounds appealing to be kind of doing away with waste and bureaucracy. And certainly there's a lot of reform that the U.S. Would benefit from having in all kinds of ways. But we're talking about something political scientists like me call norm erosion. That sounds incredibly dry and boring, but it means that we don't follow rules or procedures or established ways of doing things. There are going to be some negative surprises, too.
Tina, what's the roadmap between now and January 20th? When you think about what's going on around the globe, in the Middle East, in Ukraine, you even had just really days ago, Russian President Vladimir Putin saying he's ready to meet Trump. But at the end of the day, do you think that there's much more uncertainty moving into the beginning of next year, given that we're in a state of transition?
Well, let's just say that I haven't planned any Christmas or New Year travel. And I just took stock of all of the kind of rapid reactions that we put out this year. It's not possible to make a causal correlation in terms of the kind of surprise events that they are, directly because of Trump and the weaker links in political coalitions and otherwise are starting to drop as a result. But there's going to be a lot of losers to Trump coming to power. The next few weeks, we've got, a month and a few days before the inauguration, although Trump is already, really acting like he's president now and being treated like he's president now. We had the fall of Syria. We've had Israel advancing on continuing to undermine some security positions of its adversaries in the region. This is a great time to take advantage of a political vacuum, in fact. And so I don't think it's going to be a quiet Christmas or early New Year. And there'll be more jockeying for position with the new administration. No one knows what form the bargains will take, what they can offer the Trump administration in order to avoid tariffs. That's how it looks from abroad, in answer to your question. What is he going to ask us for, and what can we give him?
All right, Tina, great to get some time with you. A lot to look forward to, it sounds like. That, of course, is Tina Fordham of Fordham Global Foresight, and to David Gura. You can listen to David's interview with Antony Blinken on the Big Take podcast. You can find that wherever you get your podcasts. Now, still ahead, Blackstone's Holiday Yeehaw. We'll have a peek at the newest video drop next. This is Bloomberg.
Tour. You need to go on tour, like Taylor.
This is an absolute banger.
I love it. We were rejected by every venue.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, thousands of Amazon workers at 7 U.S. facilities walked off the job early this morning during the holiday shopping rush. Warehouse workers in cities including New York, Atlanta, and San Fran taking part in the strike. Amazon, for its part, said it does not expect any impact to its operations. Next up, Lennar falling after its first quarter guidance fell short of estimates. The home building company lowered its full year guidance and also filed plans to spin off most of its land holdings into a separate public company. And finally, Blackstone is out with its annual holiday video. It features 200 employees and a country music sing and line dance routine. Remember, last year's Taylor Swift-inspired version attracted widespread attention, with over 8 million people tuning in to Steve Schwarzman's alternative era. And Sonali, I love a theme, and I do appreciate that Blackstone, they really go for it with these videos.
They do. Certainly more and more Blackstone executives starting to make bigger and bigger roles in that video. Also, as somebody who has bought 6 pairs of cowboy boots this year, I appreciate it. I'll stick with us. We're going to switch gears. We're going to talk to Dynex's co-CEO about mortgage markets in the next block. Stick with us. This is Bloomberg. U.S. existing home sales data out in the last 30 minutes, topping a rate of 4 million in November for the first time in 6 months. That's as house hunters begrudgingly start to accept mortgage rates that are still above 6%. Smriti Popenoe, she's Dynex Capital's co-CEO, president and chief investment officer, joins us now. Dynex Capital is a real estate investment trust that invests in residential and commercial mortgage-backed securities, very heavily tied to interest rates. Smriti, when you saw the Fed's decision, what was your initial reaction, particularly to the market moves that came thereafter?
Yeah, I think stocks reacted very much more than bonds did. So when you look at what the bond market did yesterday, it was well within the break-even expectations for the market. So the bond market had kind of understood the idea that inflation would probably not come down, in a smooth fashion. I think that was a bit of a surprise to stocks. Also, I think just Chair Powell acknowledging that inflation isn't coming down like the way they want it to was a bit of a jolt. And I think injecting that level of uncertainty had an impact on risk assets.
Yeah, absolutely. You could see that surprise across asset classes. He didn't really express a lot of confidence in his own inflation projection, so we'll see how that shakes out. But talk us through how that touches the business that you're in. Of course, like Sonali said, residential and commercial mortgage-backed securities. Yes. What is the daisy chain that it looks like when it impacts your market?
Absolutely. And one of the most interesting things that's happened this year is the disinversion of the yield curve. So for the last 2 years, you had long-term interest rates actually below short-term interest rates. But in September of this year, because of the dovishness of the Fed, the yield curve disinverted. And what that means is that the yield on the 2-year Treasury is actually lower than that of the 10-year Treasury, and it hasn't done that for some time. So for businesses like Dynex, we are able to earn the spread, the credit spread of agency mortgage-backed securities priced off of the back end of the yield curve, but we're financing in the front end. And so that really has created this accretive investment environment that I'm out telling investors about.
We've been talking a lot on this program, not just about that sharp movement in short-term rates, but the stickiness in the elevation of longer-term rates.
Yes.
And that 10-year above what we've been kind of nicknaming as that danger zone level of 4.5%.
Right.
Drifting yet higher still.
Today.
What's the ripple effect of that, especially when you're looking at mortgages that are perhaps much more tied to those longer-term interest rates?
Absolutely. One of the things that, so mortgage rates are tied to the back end of the yield curve. And a lot of people forget that the back end of the yield curve is really driven by private investors and private investors' demand for yield. So when you do see these higher interest rates, you're learning that investors demand more return in order to lend their money for that long time period. Mortgage rates very much tied to the back end of the yield curve. They've been above 7% now for some time. It's good and bad for investors like Dynex. It's excellent because you're able to earn that incremental yield. If you're a homeowner or a borrower, you now have to start focusing on your credit score because that's one way to actually get your mortgage rate down. But in general, you are going to face higher mortgage rates as a borrower. Investors like us, we love it because we can actually earn higher yields.
And you have an interesting perspective, of course, because you sit in both residential and commercial markets. Where are you seeing the most opportunity right now?
Yeah. So ordinarily, our company has invested in both resi and commercial. It's a great way to diversify. Because of what's happened in the commercial real estate markets, we have actually not been invested in that markets for the last 2 years.
Oh, interesting.
Yeah. So we are almost all in agency residential mortgages today. And if you go back and look at any of your Bloomberg OAS charts, right? They will show you that agency mortgage-backed securities are the one asset class, government-guaranteed asset class that has underperformed a lot of fixed income. So mortgages are cheap to corporates, mortgages are cheap to high yield, they're cheap to so many different sectors, and that's our reason for focusing on this sector. So we're in the resi space. When you buy agency mortgage-backed securities, you don't take credit risk, and we think it's a fantastic return environment for that.
It's really interesting that you haven't been involved in commercial for 2 years. And with that in mind, what needs to happen to bring you back into that space?
So I think, when I say commercial, we focus a lot on the multifamily market. The multifamily market has been very resilient because of the demographic story, as you guys know, with housing shortages and so on. Having said that, for us, it's all about price. So, we have a saying in the bond market, no bad bonds, just bad prices. So one of the things that's happened in the commercial sector, the good properties, the good loans are all really well bid. And then you're left with sort of like the office sector and other sectors that have struggled, difficult to really put money to work there. So half of it is because of price, half of it is because really the risk hasn't fully gotten washed out. And that's why we're not there.
You were talking about the stickiness a little earlier when we think about the residential market.
Yes.
Do you think consumers are going to just have to start accepting mortgage rates above 6%? When does that psychology start to set in after so many years of mortgage rates below 3%?
So you saw the existing home sales number just come out, and it was higher than expected. I think that is starting to show signs where people are saying, look, I don't think I can get a mortgage below 6% anytime soon. One of the things that has happened in the mortgage market the last 2 years, you haven't seen mortgage rates much below 6%. Okay, so we've had 2 years of actually acclimation happen. House prices are still higher, and so now you are seeing people trade off and say, look, I've got home price appreciation. I think I'm going to trade off the appreciation for the higher mortgage rate so that I can move or do that next thing.
If you don't capture that appreciation now, do you risk a fall off in the housing market? There are two camps of thinking here. People who believe that the only direction is up. But there is a fear that if you start to see that selling, that the reset value is actually much lower than people realize.
And so, yes, I think if you do see some velocity in home sales, should it affect the price? It should. And is it going to be a massive, 15, 20% correction? I don't think so, just simply because of the amount of demand there is for housing at this point. So maybe you get 5 or 10% below what you thought you were going to get, but you can still get out with a gain on your house.
So before we let you go here, too, I have one more question for you. And it's because the Trump administration, there's a big expectation that the one thing that they might finally tackle once again is Fanny and Freddy, the privatization of them. Do you think it could happen?
Absolutely, it could happen.
And what's the ripple effect?
So the ripple effect, there are many. You know, could it happen? Yes. Will it happen? I'm not so sure. What it takes to make it happen is actually enormous. So just our research shows that it would take about $200 billion in an IPO for Fannie and Freddie to become private. When I worked at Freddie Mac when it was a private company for 9 years, we had public shareholders, we had preferred shareholders, we issued debt, and so is it possible for us to go back to that private structure? Absolutely, but the amount of capital that's required, I mean, it's about 10 times the largest IPO that's ever been done in global markets. So it's a big ask. You know, from our sources in DC, we're hearing that it's really not a huge priority for the Trump administration, at least not in the first 2 years. So if it does happen, it would happen later. Could it happen? Absolutely. If it did happen, I think one of the things you'd have to be very focused on is the impact on mortgage rates and whether it actually does help bring mortgage rates down or up. It's unclear to me, like having a private structure, whether or not, you know, what real impact that would have.
Smriti, we're going to have you back. That is,
Thank
we'll
you.
have you back before then, but end of 2026 is when that conversation might pick back up again.
Sure.
Smriti Popenoe of Dynex Capital. We're going to get a check now on the market, see what's moving under the hood with Bloomberg's Abigail Doolittle. Abby.
Well, we have mixed markets at this point here. You can see, Shanali, we have the NASDAQ 100 up about 0.2% at the highs at more than 1%. So after yesterday's big Fed day sell-off, that hawkish Fed, we had a rebound and now not so much. The KBW Bank Index is up a little bit. And then take a look at the stocks, down 1.2%. The S&P 500 below its 50-day moving average for a second day in a row, suggesting that maybe there's more weakness. In fact, let's take a look at that S&P 500 over the last 2 days to see the sell-off, put it into the perspective. You can see over the last 2 days down sharply. Today up about 0.4%, but over the last 2 days down more than 2% again after yesterday, the worst day since August. The SKU index, we often talk about the VIX, and that did certainly spike above 25 yesterday, back above 20. So that is a healthy level, not so complacent. But the SKU index, if we go into the Bloomberg terminal, this is the panic index, the far out of the money puts that really suggest that somebody's either putting on major protection for a correction. This index spiked well ahead of the pandemic, and then it is at a record high now, suggesting some investors are worried. And then finally, some movers beneath the hood for the S&P 500. Darden Restaurants up 14.5%. The outlook great. Longhorn Steakhouse really doing well. CarMax, they beat up 4.4%. The CEO saying the environment is more stable. That's helping. Lamb Weston, they cut the forecast. They're replacing the CEO, the stock plunging. And then finally, Micron also plunging. And of course, their cut of guidance by more than $1 billion for sales on weakness for PCs and iPhones. Katie, investors not liking that at all.
No, a good reminder that earnings season is still here and it still matters. Our thanks, of course, to Bloomberg's Abigail Doolittle. Now, coming up, the funding crisis facing federal agencies. Boy, it's been a long week. That's next in today's Wall Street Week Chat. This is Bloomberg.
This is Bloomberg Open Interest. I'm Abigail Doolittle in the principal room. Coming up, an interview with PGIM CEO David Hunt. That's at 3:30 p.m. New York time. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And President-elect Donald Trump says he will cut government spending when back in office, and that could threaten a handful of statistical agencies. Bloomberg's Molly Smith spoke with former Bureau of Labor Statistics Commissioner Erica Grosjean and George Washington University professor Andrew Reamer about the potential impact.
A slimmed-down federal government could present a threat to a handful of statistical agencies that have been sounding the alarm on their cash crunch for years. The Census Bureau, the Bureau of Economic Analysis, and the Bureau of Labor Statistics are all under financial strain. The BLS collects and analyzes U.S. employment data, and it lays claim to what could be the single most important piece of information in the world of finance, the monthly jobs report.
Every year, BLS lost purchasing power, right? Salaries for the workers were going up, but the budget was not.
Erica Groshin is intimately familiar with the BLS's fight for funding. She served as its commissioner under President Obama from 2013 to 2017.
You start almost 2 years beforehand, right? So you've got one budget kind of in process and you're pulling together the next year's budget. The department sends that budget to OMB, and from all of the departments, so the Department of Commerce, Labor, et cetera, the OMB helps the White House pull together what's called the president's budget. Then it goes to the House and to the Senate, and each of those appropriations committees winnows it down further. So it's a long, drawn-out, complicated process where you're continually giving up on ideas that and necessities that you really wanted to be funded.
The BLS, Census Bureau, and the BEA had a combined $2.2 billion budget last year, just 0.03% of federal spending. After adjusting for inflation, BLS funding has slumped almost 20% since 2010.
Congress, unlike its predecessors in the 19th century, has lost sight, in my opinion, of the value of the statistical system.
Andrew Reamer at George Washington University has been researching the role of policy in agency funding for 20 years.
Back in the day, 200 plus years ago, the primary customer for the data was Congress. There was no internet. The data if it was published way late. No one could really use it. Our world has changed, and so we're on Wall Street Week. The first Friday of every month, the stock market does something on the basis of the numbers that come out on Friday morning regarding unemployment and jobs. The Fed needs that data. The second thing that happens when that data come out the first Friday of the month is that Chairman Powell goes in front of the cameras and says what it means for the Fed cutting or not cutting interest rates.
And that was Erica Groshin and Andrew Reamer speaking to Bloomberg's Molly Smith. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
And that was Fed Chair Jerome Powell speaking yesterday after the Fed cut rates for a third straight time, of course, but all attention was on the dot plot, penciling just 2 rate cuts for next year. Also, Jerome Powell, when asked if he is ruling out a rate hike for 2025, said that no, he could not rule that out. So obviously that really made ripple effects in all markets. And you're seeing the after effects even today. Of course, the S&P 500 falling by nearly 3% yesterday. It's climbing back today, but even that rebound rally losing a little bit of momentum right now. The S&P 500 up by about 0.5%. We had been higher by 1% on the session, which had been the biggest one-day rally since, I believe, the election, Sonali. But there's a lot of question marks, and you're seeing that doubt, even with this rebound that we were looking at earlier this morning, really creep in right now.
I would say also, some people look at the 12 days of Christmas. I'm looking at the 9th day of the rise in the 10-year.
Yeah.
So it's not just one day's move. It is that longer-term drift higher in the long-term rate as well that is fascinating, both with the Fed as well as those fiscal pressures that are under the surface.
And it was interesting to hear John Stoltzfus at 9:30 blamed the bond market for what we saw yesterday, saying that actually it was the sell-off that was being led by the bond market rather than just the stock market throwing its own tantrum. Let's broaden out and discuss it all with Bloomberg Chief International Economics and Policy Correspondent Michael McKee sitting to my left. So let's talk it through. We've been chatting for the past 2 hours about how this didn't seem that surprising. The idea that the Fed was going to pause its rate cutting trajectory was socialized, I would say, but still you could really see that shock in the markets.
Well, I think it was the inflation forecast that they raised it higher than people anticipated. And
partly because, as Chairman Powell said, some of the members incorporated some thoughts on what the Trump administration's policies would be. And that led the markets to believe that maybe even 2 is too many rate cuts. And if you look at the markets, they're only pricing in 1 for next year. And so that then scared everybody. The long end went up and we saw stocks fall. But I think at the end of the day, when we had the big crash, that was probably people saying, the markets are going down. I've had a good year. I'm going on vacation and I'm not going to be here the last 2 weeks of the year. So let's take a little profits and sell into the fall. And then, today you've seen a bit of a comeback.
It's interesting. Between now and the end of January, you have a lot going on. You have, of course, the inauguration, but then at the end of January, the next Fed meeting as well, jobs data in between. Given what we heard yesterday, the new information we have about how the Fed feels about the data they have so far, how do you feel about the next sets of data that you're going to have to read through to figure out what that path ahead is going to look like?
Well, I think we got some really good data today. The GDP numbers being revised up in the third release is unusual for the size of the revision to 3.1%. Consumer spending strong and business spending rising even more than in the earlier releases. So the foundations for the economy are pretty good at this point. And that will raise the view of what the fourth quarter may be. And then you go into the beginning of the year, we're going to be in a suspended animation situation because I don't know about consumers. They may continue to buy, but businesses aren't going to invest. Everybody's going to wait and see what the Trump policies are. So for the first month, we're not going to see a lot of activity. We'll see what the December numbers were, and hopefully people were spending. I don't know what you get somebody for the 9th day of market drops. I don't know if it's 9 stocks is sinking or something like that. But
bonds are sinking. The stocks are just fine.
I think according to the 12 days of Christmas, it's just a lot of birds. Every day you get them just another bird. But I want to go back to what you were saying about the inflation projection, of course. Thinking that inflation will decline to 2.5%. That was in the latest summary of economic projections. Powell not exactly making very confident noises about that. And I thought it was interesting that he said that the Fed's expectations that inflation will decline in the second half of this year had fallen apart given the last few months of inflation that we've gotten. You think about the Fed speak that we've gotten, and several Fed speakers had been pretty clear that they don't think inflation, that disinflation trend, had stalled out. But Jerome Powell seemed to be saying something different there.
Well, there are a couple of people on the Fed, including Beth Hammack, who dissented yesterday, who think that the inflation numbers have stalled out. It's a debate. As Powell said, it was a much closer call this time. The numbers don't lie. The last couple of months, we have not seen progress on inflation. There were some numbers under the numbers, particularly the housing number in the CPI, which came in at 0.2% for owner's equivalent rent, the first time we'd been there since 2021. So if that is a precursor to continued drops in housing prices, then inflation should come down significantly in the coming months. If not, they're worried about what might happen with tariffs, et cetera. So it's really hard to know, and this is going to be a division on the Fed for some time.
It's interesting as well. I covered Beth Hammack for a long time at Goldman Sachs, very intimately involved with the Treasury market because she was the chair of TBAC for a while there. So to have her come out and make a splash with that first dissent, it was a big deal.
Well, you had people say, this is the woman from Wall Street. If she thinks it's a problem, then Wall Street may think it's a problem, which may have contributed to yesterday's sell-off.
All right, and it'll be interesting to see if we get more dissents as things get a little bit trickier, especially with the fiscal situation in 2025. Our thanks, of course, to Bloomberg's Mike McKee. Now, coming up tomorrow on Open Interest, Christina Hooper of Invesco, as well as Crunch Fitness CEO Jim Rowley. All that and more coming up. This is Bloomberg.